Hello everybody, just a little video for you today on the benefits of financial diversification for business owners. It's an area we often talk to business owners about, and the implications of the COVID-19 pandemic have obviously heightened the awareness amongst some that actually you can't always rely on your business to give you the financial outcomes that you ultimately want in retirement, particularly when events outside of your control can obviously have an impact on the financial well-being of your business and then ultimately the financial well-being of yourself. So what we try and talk to people about is the ways in which they can diversify that well-being away from their business while still having the ability to support their business where needed financially. So there's a few points I'll take you through today which hopefully will give you a little bit more insight into some of the things that you can look to do. Obviously, every good presentation has a few risk warnings. Just a few there for you, but the main one I would really emphasise to people is that you should always seek professional advice for making any investment decisions, or indeed any financial decisions really, whereby there are significant implications to yourself and your future financial well-being. So moving on, the benefits of diversification. Now, this isn't talking about for a business about how to diversify your product range or how to diversify your service offering that you may offer to your clients. It's purely looking at the benefits of diversification from a financial perspective for you as an individual. So lots of business owners, obviously they know their business, they love their business in a lot of cases. It's something they potentially have started from scratch and built up to being where it is today. And as a result, they are often wary about looking at alternatives or looking at solutions that sit outside of the business when it comes to their finances. However, one thing I always try and reinforce to people is that things that are completely outside of their control can have a major impact on the performance of that business. And this is something obviously that we've seen today with COVID-19. Very profitable businesses in the travel industry, in the hospitality and entertainment business have really struggled over the last few months through no fault of their own. And often they were, prior to COVID-19, a really, really profitable business. We have clients in that exact position today. And one of the things that has become apparent is if you're hinging your retirement plans, your future well-being, on an event in the future, such as the sale of that business, you can't always rely on that, particularly not at the time at which you wish to ultimately step away, potentially not for the price that you may need to meet the standard of living that you want to have in retirement. So it's worth having a think and thinking about alternative strategies that can be deployed along the way, where hopefully, obviously, all being well, you'll still be able to, at some point in future, realise some capital value out of the business. But if that is delayed for any reason, or if it is not the value that you're looking for, that you have alternatives to support your standard of living in the meantime. So those are obviously just a few key reasons why we suggest that people consider diversification within their financial plan. So this is obviously something we see a lot, and in most cases, people's retirement when they have a business does depend on the business. A lot of people obviously look to sell. Some may rather that a family member steps in and takes over. But again, that's not always straightforward. Has the business got sufficient income through all eventualities to maintain you still potentially taking an income via dividends or salary, as well as the people who you're going to actually need to run that business as you step aside? Is it profitable enough to allow you to do that? And even if it is, how will you feel ultimately about losing control, handing over the reins to somebody else, and your income potentially being reliant on the performance of somebody else? Other people obviously prefer just to have a clean break and step away with a capital lump. But again, there can be issues, as we've already mentioned, regarding that. So what we talk to clients about is how they can achieve diversification throughout their life. This is not just something to consider at the point of retiring. It's part of a plan that needs to be put in place and adjusted the whole way through life. These are just a few of the different wrappers that can be used and utilised for different tax benefits when looking at planning for retirement, or indeed planning for any financial eventuality. Sitting outside of this circle as well, this graphic, you can also have your business, because as I say, it doesn't mean that you necessarily sell at retirement. Or you could have a rental property, a commercial property perhaps, that the business premises provide rent for. So there are other things that can sit outside of this sphere that are not linked necessarily to investments or a portfolio that financial wealth managers such as myself might manage for you, but which obviously are very key and form a big part of your financial plan ongoing. But how can your pension support your business? Now, there's three key points here that I'll talk you through one by one. The first is that the pension can actually be your landlord. Now, this is something that more people are looking to utilise because more people become aware, but it's still something that's not always appreciated or taken advantage of. So a lot of people have negative perceptions of pensions, partly through the historic mis-selling scandals that have gone on over the years, partly through people hear the word pension and they think annuity. They think that the funds that they build are lost on death, which is absolutely not the case, and something I'll talk you through shortly. But also broadly just because they don't necessarily understand the rules. Pension rules have changed a lot. They have not remained the same, probably for more than 12 months at a time over the last 20 years. So that can be hard for people to get their head round. And as I say, when you know and understand your business, it can seem a lot easier just to leave the money or the cash within the business rather than looking to move it out into a pension scheme. If you are lucky enough to have a pension fund that is of a sufficient size that you could potentially look to purchase a commercial property, it could be the premises that your business operates from, but it doesn't have to be all of the premises. You could potentially own them with a co-director and have a percentage each. Or if there's insufficient money within your pension fund, you can actually, depending on the type of pension, borrow against the money in the pension fund to enable you to potentially purchase a bigger property than you might otherwise be able to afford based on the value of the pension. And within a SIPP or SAS arrangement, you can normally borrow an additional 50% of the value of the pension pot to enable you to do that. So that's something that can be very, very beneficial for business owners. The benefits, obviously, there's a few listed here. The main one, obviously, is that the rent that you'd be paying to your landlord, if it's a third-party landlord, obviously that's just dead to you. If it's yourself as an individual, normally you'd be paying income tax on that rent as you receive it as an individual. If it goes into your pension fund instead, because the property is owned by the pension, then there's no income tax paid by the rent, or by the pension fund on the rent. There's also the ability for you to still deduct it as a fully tax deductible business expense for corporation tax. So that again can be very beneficial. So you're effectively paying yourself, broadly, via the pension scheme, rent. And obviously you can step away from business, you can sell the business, but you don't have to sell the premises. You can still keep those going forward, and that can provide an income stream into retirement via the rent. There's also no tax on the value of the growth within the pension fund. So that could either be the rent accumulating within the fund, or it could be a capital increase on the value of the commercial property within, the investments within. And you're also no longer at the mercy of a landlord. Now, just because the pension scheme owns the property doesn't mean that you can just avoid paying the rent. Unfortunately, you still are, obliged to pay that going forward. But at least you are your own landlord. So in reality, you're far, far less likely to consider kicking yourself out if you get into arrears than a third-party landlord may do. So you have that additional reassurance, really, that you are your own landlord going forward. And again, if you own those premises personally, currently, or even the business owns them within the business, the pension scheme can buy them off yourself or off the business, obviously for market value, and that can provide either you with a cash injection or potentially the business with a cash injection, which could be much needed depending on the business cash flow situation. Another benefit that people often aren't aware of is that the pension fund can actually loan a sponsoring employer, in the case of a SAS, make a loan towards the support business. So if, for instance, you had a pension fund of £500,000 in a SAS arrangement, that SAS could actually loan the sponsoring employer attached to it up to £250,000. Now, there are various things that need to be met in order for that to be possible, and obviously there's a few there. There's a maximum amount of the loan, which, as I say, is 50% of the value of the SAS. There has to be some security, but that doesn't necessarily mean that the security is owned by the sponsoring employer. So land and property is one of, obviously, that's often used, but it doesn't have to be that the employer itself owns the land or the property of which the loan is secured against. It could be, you know, if the director felt confident enough about the business's ability to repay the loan in future, one of the directors might be willing to put their own property or either their main residence or a rental property up as collateral for the loan. So provided there is some form of security, and as I say, property tends to be the easiest option, that's normally allowable. Also there's a set term of which the loan can apply, which is 5 years, and that the loan has to be repaid in equal fixed monthly instalments. The final thing regarding pensions that we'll sort of touch upon in how they can sort of support you and also your business is that as a business owner, you are able, or your business is able on your behalf, to make pension contributions each year. Now, again, if they're made by the business, it's a fully corporation tax deductible expense as a business expense. You can normally make contributions of up to 40,000 per annum, but potentially if you've got unused allowances from previous years, you can actually make contributions in excess of that. In some cases, you can also, you're also limited on your contributions, so it's always worth, again, seeking advice to make sure you don't fall foul of the annual allowance for if you have very, very high earnings and are subsequently tapered. The benefit of doing so is if an individual is over 55, well, apart from the obvious benefits of having more money in your pension fund in your name and out of the business accounts, but another benefit of doing so is that if the individual in question is over the age of 55, it can actually be a useful way of withdrawing income tax-free from the business, because you can make a 40,000 contribution and then immediately take 25% out completely tax-free. So that can obviously have significant cash flow benefits as an individual. You're not paying any income tax on that. The residual contribution sits within the pension, and you can keep doing that each year. So as an exercise, again, about getting cash out of the business and into your own name, it can work very well. You can still continue to make contributions even if you've accessed pensions. You have to be a little bit careful about not taking taxable income, because then that reduces down your allowance. But provided you just take a tax-free lump sum and no income, you're normally fine. Then we come on to business and estate planning. Now, this is, again, something that we often talk a lot about with business owners. Whilst the business is in place, provided it meets the relevant criteria, often it will qualify for business relief, which means that the value of that business is exempt from their estate for inheritance tax. So there's relief in place, which means it can be passed on without any inheritance tax being deducted. Often when people come to sell their business, obviously they're then provided with a potentially large cash lump sum in return for the shares in the business. And all of a sudden, the value of their estate for inheritance tax purposes is much, much larger. In those instances, we often recommend that individuals, again, seek advice in the run-up to making the decision to sell, partly because that can allow any surplus cash from the business to be diverted into pensions or other things, which can allow then the business to potentially qualify for entrepreneurs relief, as was, which otherwise may not, because that doesn't always apply if there's large sums of cash sitting within a business. Normally, any cash within a business has to be sat there for a purpose. So if it's for potentially looking to buy new premises or new plant equipment, or even potentially purchasing another business, and that's clearly been documented, then the company sitting on substantial cash reserves is normally fine. However, if none of those situations apply and the company's just sat on large cash reserves because that's how the business has always operated and that's how the directors have felt comfortable, then it's potentially possible that the business wouldn't qualify for business relief on death, and it may not qualify for entrepreneurs relief in the event of a sale. So it's always worth speaking with your accountant to make sure that the cash holdings in a business are within the recommended limits for those things. They should be able to give you an idea. Unfortunately, there's no hard and fast rule, as with a lot of things with HMRC. So it just gives you an indication, but they should be able to give you some steer on as to whether your business is likely to qualify. As I say, once the business has been sold and you suddenly have a large lump sum of cash, then you may want to undertake further planning to potentially reinvest some or all of that cash into an investment which would again qualify for business relief. And there are investments out there which will enable this, provided obviously that they're qualifying investments under the rules. A good financial planner will again be able to guide you in this, but the benefits of doing so, therefore, are there's no 2-year clock or new 2-year clock for the business relief qualification period, and that the relief is effectively carried over as though there was no break. Another thing for business owners to consider, and it's a very, very easy win, is ensuring that they have a relevant life policy in place for their family, their dependents. What this is a life insurance policy that the business can actually pay the premiums for. So again, fully corporation tax deductible expense, business expense, and that the benefit is paid to a director or business owner's dependents and family in the event of their death. Moving on, as I said earlier, make sure you have a plan, and any plan can be adjusted and will often need to be adjusted as circumstances change. But one of the key areas to consider is all business owners, I mean, everybody, regardless of whether they're in a business, should have a will. But for business owners, it's even more vital. You want to make it very clear what your wishes are with regards to your shares, particularly if you're one of a couple or a few different shareholders within a business. In the event of something happening to you, what do you want to happen to your shares? Do you want them to pass to your spouse, who may have little or no interest in being involved in the business? Or would you rather that your spouse received a lump sum of equivalent value to the shares, and that the shares were passed potentially to any other shareholders who may still be involved in the business at the time? Generally speaking, most people would plump for the latter. It's not always the case, but generally speaking, in which case you need to make sure that there's suitable cross-option agreements and shareholders protection in place to ensure that in the event of your death, your wishes and those of your co-shareholders and directors can be fulfilled. Normally it's underpinned by a life assurance policy, so that enables the surviving directors or business owners to buy out the estate of the deceased shareholder, providing then obviously his beneficiaries with the capital lump sum, and the residual shareholders with the shares. So bringing the strategy together, as I say, planning is key, tax planning is key, and it's something that we suggest that people look at the whole way through life, not just as in the run up to potentially selling a business. Those pension allowances are there every year, but if you don't utilise them, then you can only go back so many years, up to 3 previous years. So obviously you miss out on a lot. Bear in mind as well that it's up to 40,000, and you don't have to put in that much. I'm not suggesting that everybody here has got £40,000 sitting around which to contribute into a pension, but any amount will obviously build up over a prolonged period, and the benefits of starting early and receiving many years of compound growth can be quite astonishing at times. So you may spot a theme in terms of some of the things I've talked about. Pensions obviously are a vital part of a tax planning strategy for business owners. They are income tax efficient, they're CGT efficient, they're IHT efficient, and they can, in a lot of cases, actually support your business needs and provide you with future security. So when people say, well, actually, I won't fund my pension this year because I'd rather leave the money within the business to maintain the business cash flow, absolutely, that's fine. But equally, there is always the option in future, if the business needs it, that if it's a SAS, that the pension can, as I say, loan the business the money it needs if the cash flow situation deteriorates. It's also worth bearing in mind that obviously not everyone will have the types of pensions that allow this sort of flexibility in place on day one. That's fine. Most pensions can be moved, they can be transferred between different arrangements. Obviously there's certain types that we would recommend people always kept separate, but we can, with advice, discuss that. The pension freedom rules in terms of flexible drawdown will also not apply to all existing pension schemes that have already been in place prior to the change in the rules. It's just a quirk of it, but with advice, again, people can make sure that you're in the pension that is suitable for what you and your business needs going forward. Outside of the pension arena, there's also obviously ISAs. It's good to utilise your tax-free allowances if you can. VCTs, EIS, which are other tax privileged investments. Again, those ones sit at the higher end of the risk spectrum, so they're not suitable for every business owner or every individual, but they can, as part of a wider tax planning strategy, be very, very useful to obtain further tax reliefs on income. And obviously business relief, as we've talked about, can be continued even after the sale of the business if it's rolled over correctly, provided that there's good cash management in place, which is key. That's everything for today. Thank you ever so much, and I hope you enjoy it. Any questions, please do not hesitate to contact us. Thank you.